Mastering how to trade using candlestick charts has been one of the keys to my trading success. In this video, I'll teach you the basics of candlestick chart analysis and how you can use them to find the best trading opportunities. Hi, my name is Dennis, and on this channel, I share content to help you master trading, achieve financial freedom so that you can live a life of purpose, impact, and fulfillment. When it comes to candlestick chart analysis, the first thing that you need to be able to understand is what is even a candlestick chart. So on the screen is actually an example of a candlestick chart. So by definition, a candlestick chart is a chart that consists of a series of bars or candlesticks that each represent the price movement of a security over a specific time period. So it's very wordy, but just in summary, each bar that you actually see in a price chart actually is representing price movements of a particular market. So for example, let's say this chart is, for example, the chart of Bitcoin. And this particular red bar here, let's say, for example, represents 10th of September. So what it ideally is showing is that on 10th of September, Bitcoin traded between this particular price level of about 52,500 to about 42,500. So a candlestick usually shows information in terms of what price ranges did that particular market go through at the particular period that you're actually looking at. So if it's a daily chart, each of the candles will represent a day of price movement. If it's, for example, an hourly chart, each candle will actually represent 1 hour of how price moved during that particular time period that you're actually looking at. So once you've understood how a candlestick chart looks like, the next thing is being able to understand how a candle forms and how to interpret a candle. Any price candle of any particular day or any particular period actually has 3 parts. The first one is it has what is called a nose, then it has also what is called a tail, and the middle part, which is usually the shaded part, either red, green, or different other kinds of colors, is usually called a body. How exactly to determine whether one is a nose and one is a tail? As you can see here, on this chart, on this example, this candle, the nose is at the top, the tail is at the bottom, but here the tail is at the top, the nose is at the bottom. You might think maybe it's the color of the candle that determines, but that is not usually the case. The first thing to be able to understand is that these vertical lines at the top or at the bottom of these particular candles are actually called wicks. So the smaller wicks are usually called noses, and the longer wicks are usually called tails. So the color of the candle does not really matter, because either way, in either of them can be smaller or larger. So this is just for this particular example. See, the next thing to be able to understand about candlesticks is to be able to understand what each part of the candle represents. So the first part you are learning about the shape of the candle, which is ideally a nose, a tail, and a body. But then they don't just form out of nowhere. They usually formed based on price movements, because you said every candle represents price movement in a particular day. So what it represents, as it's shaded here, is whenever you see, for example, let's say a green candle, and maybe to back up a bit, for different kinds of charts, you'll usually you'll either set it up in the sense that when the market goes up, you want it to be shaded, let's say green. When it goes down, you want it to be shaded red. But this can be any color, so you can set it up on your chart in different colors. So in this particular case, when you see, for example, a green bar, what usually means is that the market opened from a lower price, then closed at a higher price. So this is just first of understanding opening and closing prices. So the market opened, let's say, at 50,000, closes at 55,000. So that will form the open and the closing price. Then the two extreme points are usually called the highest price that the market reached at that particular day. If you're looking at a daily chart, if, for example, you're looking at an hourly chart, is at that particular hour, let's, for example, it's 12 p.m. At that particular hour, what was the highest price that the market reached? What was the lowest price the market reached? So those will form the highs and the lows. So the high and the low will always remain at the same position regardless of the color of the candle, whether it is a candle that is moving up, opened lower, closed higher, or a candle that opened higher and closed lower. So they'll always remain the same. But the opening and closing price will shift based on where the market actually opened at. So if the market opens lower than the eventual closing price, it will be a green bar. If it closes lower, it will be a red bar. So it's very basic stuff, but they'll be very important even as you will be trying to understand how to use this information to actually determine our entry points. The next thing when it comes to candlestick chart that you need to be able to understand is the various kinds of candlestick patterns that are actually out there. So first of all, you've been able to understand how to interpret the shape of a candle. So you've been able to see there's a body, there's a there is a nose, there is a tail, depending on the length. Like for example, in this example, this smaller part here would be a nose, this would be a tail. Like for example, in this particular case, the nose is smaller and is at the bottom, meaning this will be the nose, this will be the tail. Now, that particular information in combination with the size of the body, like you can see this has a small body, relatively, you can say medium body, very large body, then these are the candles. So these are what usually form the various kinds of candlestick patterns. So depending on how close the opening and the closing price will be, and how low the low price will be from the opening price, and how maybe the high price will be from, let's say, the closing price or the opening price, it will form different kinds of candlestick patterns. So depending on the shape of these particular candlestick patterns, they will signify different kinds of scenarios that are more than likely going to happen. So they will signify, for example, whether the market will go up or whether it will go down. So they're usually categorized into two main kinds of patterns. There are what are called reversal patterns, then there are what are called continuation patterns. So what do each of these particular patterns actually signify? So as they actually know, as they are named here reversal, whenever you see a reversal pattern, it usually means there is a likelihood that the current trend of that particular market is going to reverse in the direction that that particular candle is actually showing. So like for example, this first candle is called a pin bar. So whenever it has this longer tail pointing lower, it means the market is rejecting lower prices and is more than likely going to go in the opposite direction. It is actually going to go up. And in the opposite scenario, this second one is also a pin bar. And since the tail is longer and it's pointing upwards, it means market participants are rejecting higher prices, and most likely the market is actually going to go lower. So if, for example, this appears, usually indicates, for example, you should be buying. And if this forms, it usually indicates that you should actually be looking to sell that particular market. So these are the candles. For example, this is a tailed bar. It has a large body, so its tail is still pointing lower and it's longer than the nose, but because it has a large body, we usually call it a tail bar. And it's another reversal pattern. Like the market, let's say this will usually form like the market is going down, then the market, this particular candle forms, showing that the market is likely going to reverse to the upside. Then this is the opposite, is now a tail bar still, but then it's signifying that the market is actually likely going to go lower. So there are other criteria that you will add on top of identifying the signal. So this can be a beginning point of entry signals that you start learning to identify in the market. Then the other form of candlestick patterns are usually called continuation patterns. And just as they are named, like this is one pattern. It's not like each candle is representing a different pattern. This is one combined pattern that is usually called an inside bar. So a continuation pattern usually indicates that there is a likelihood that the current trend is actually going to continue, that the market has paused for a while and there's likelihood that the market is actually going to continue on. So for example, if this particular candlestick pattern forms when the market is going up, it usually means that the market has paused for a while and there's a likelihood that that trend is actually going to continue on based on how it was before. And if it forms when the market is going down, it's usually indicating that the market's downtrend has actually paused and is likely it's going to continue. So this as well is an entry signal that I personally trade with when I actually find them in the markets. So these are the two major categories of candlestick patterns. So there are many candlestick patterns you can find online. I don't think they can go even up to maybe 100 types of candlestick patterns, but not each of them has a good probability of actually working out. I've tested many different kinds of them, but these are trading signals that are found to work for the various kinds of markets that I actually trade, from forex, cryptos, commodities, stocks, and much more. But then the next thing that you need to be able to understand when it comes to candlestick patterns is what are bullish kinds of candlestick patterns and what are bearish. So this might be new terms, for example, to you. So whenever you hear someone saying, or somewhere online written that, for example, the market is bullish, it usually indicates that the market is going up. The market prices are going up. Or if they say that the market is bearish, it means that the market prices are going down. So signals are also categorized not only based on what they are, like a reversal pattern or a continuation pattern. They usually categorize based on being either they are bullish, indicating that prices are going to go up, or whether they are bearish patterns, indicate that the market is going to go down. So whenever you see a bullish pattern, it indicates that you shouldn't be selling, you should be looking to buy. And whenever you see a bearish pattern like this one, you should be looking to sell. So like this is a bullish. So the distinction between the two is that the direction of the tail. for the candlesticks pattern that you've learned. So this ideally is for the two candlestick patterns, the tailed bar and the pin bar. So as you can see here, for all the bullish ones, you can see their tails are pointing lower and they are longer to the downside. And for the bearish one, their tails are pointing upwards. So this is usually very important to be able to identify, because you don't want to identify a bearish signal like a bearish pin bar and then you look to buy that particular market. So this is a very simple way to be able to know whether you should be looking to buy or sell, or where the market is actually likely going to go. So it's just one step. There are other things that you'll actually need to add on top of this to be able to know whether it's a good time to enter that particular candle. But this is the first step of knowing candles that indicate good time to buy and good time to sell. So before I share with you how exactly you can be able to use these candlestick patterns to find the best trading opportunities, I would like to share with you a free training that can help you to be able to learn how you can be able to attain financial freedom through trading. So in this particular training, you'll be able to learn the 3 parts to financial freedom through trading. So in trading, there are actually 3 kinds of ways in which you can be able to gain financial freedom. So you'll be able to learn them in this particular free training, and you'll be able to evaluate yourself and see which path suits you the best, because different paths will suit people differently. The next thing that you'll be able to learn is how much money can you actually realistically make in trading. So there are many people online that flash, you can make $500 a day, 2% per day. You can make millions within a very short period. But then what is really realistic? So I'll share with you, based on my years of experience, how much money you can realistically make depending on the path you choose. So then you'll be able to have a clear step-by-step plan on how to be able to attain that financial freedom. I will also share with you the exact resources and tools that you need to be able to start trading the right way. If you don't have the right resources, then you will actually slow down your growth as a trader. So I'll share with you what I've actually used and what has actually found helpful to actually find success in trading. Then I will also share with you the 3 steps that you need to be able to take before you start live trading. You might actually have already started trading live with actual money, but in this particular training, you'll be able to learn and be able to evaluate yourself. Have I actually gone through these 3 steps? Because if you skip any of these particular steps, you are more than likely going to blow up your account along the way. So this is the kind of thing that I would have wanted when I was actually starting in trading. So I encourage you to sign up for it. You'll be able to find it on my website, denniskirui.com/YT, or you'll be able to find the link on the description of this particular video and also on the pinned comment. So then what are the benefits of using candlestick charts, and how can you be able to use them to find the best trading opportunities? So candlestick charts will help you to identify entry signals. Based on what you've been able to learn thus far, you've been able to learn what are bullish signals, what are bearish signals. So those signals, you can be able to use them to identify that this is a good time to buy, and this is a good time to sell. So based on the signals that you've been able to learn, like this is, for example, a pin bar. So when you see a pin bar like this, then it means there's a likelihood the market is actually going to go higher, meaning it's a good high probability opportunity that is actually going to be a profitable trade. And if, for example, you see this is a bearish tail bar, it indicates that the market is actually likely to go down. So it's a good signal to be able to sell. So the first point of candlestick chart, they can be able to help you to identify good entry signals. So don't just enter the market. Like when I was starting out, I'll just see big bars going up, and then I'll see, oh, this market is going up, I have to buy. Or big bars going down, I need to sell. No, you need to actually wait for these kinds of entry signals that you've been able to learn, the pin bars, the inside bar, the tail bar, to signal to you that is a good time to either buy or to be able to sell. But that is not the only thing. I don't want you just to learn these entry signals and go ahead and start looking for them and trading them. You need to add another element of candlestick chart analysis, which is identifying support and resistance levels. So candlestick charts can also be able to help you identify good areas to either buy or sell. So for example, a support level is whenever the market reaches that particular level, more often than not in the past, the market has reversed going upwards. Like in this particular level, you can see it came here, bounced up, came here, bounced up again. So that the next time the market reaches that particular level and you find an entry signal, there is a high likelihood that if you enter that particular trade, you'll actually have a profitable trade if you implement that strategy over a large series of trades. Then the next thing is the resistance level. So a resistance level is ideal whereby the market, whenever it reaches that particular level, it reverses to the downside. Like you can see here, the market reached here, reversed lower, reached here, reversed lower again. So A resistance level is also a level that you can be able to identify using candlestick charts. So a simple way that you can be able to implement this, even and start going to backtesting on your own charts, on your brokerage account or on TradingView, is whenever you see at least 2 times when the market has reached that point and reversed upwards, then that is a support level. And the reversal needs to be a big reversal, not just a small reversal and then it comes back lower. It needs to be at least a significantly large reversal to the upside, and it needs to happen at least 2 times. Don't just take one reversal and say this is a support level. It needs to reverse at least 2 times. And then for a support level as well, it works the same way. At least 2 reversals, but not to the downside. Then never feel as if just because the market has not one time hasn't reached that level or it broke through, it's not a support level. If it has at least 2 significant reversals, mark out those levels on your chart. Those are levels to look for the signals that we've been talking about, the pin bars, the tail bars, and many other type of trading signal. Like you can see in this example, at this particular level, there was this pin bar here, there was a tail bar here, you can see another pin bar here, a tail bar here. So you can see how in these levels, you can be able, once you're able to identify these levels, and using the rule that I was saying, 2 reversals in the past, then you can be able to start finding signals to be able to either buy or sell and to be able to start becoming profitable in your own trading. So they won't work 100% of the time, but the more you implement them in your trading, the more you'll be able to find success over the long term. The next thing that candlestick charts can be able to help you with is what is called trend analysis. So whatever I'm teaching you right now is stacking up your knowledge so that then once you look at a chart, you can be able to know what is a good trading opportunity. So we've learned first identifying an entry signal, this inside bars, up pin bars, tail bars, and you've learned about how they look like. You've had an idea of how they look like. The next thing is looking for those signals at specific levels. And you said support or resistance levels where the market has reversed at least twice in the past. So you look in the last, for example, 6 months, a year, what levels has the market reversed from? Then you wait for entry signals on those levels. But then on top of these 2 things, the next thing that you need to be able to add is identifying what is the trend of that particular market. Because just because a market has reached a level or a signal has formed does not mean that you should either buy or sell. The trend is the final thing that needs to be in alignment for you to be able to buy that particular market. So how exactly can you be able to identify a trend before even skip to how to identify the opportunities? So to be able to identify a trend, when you're looking at a candlestick chart, is look at the candlestick and see in what direction are they actually trending towards. Commonly, it's usually said in what direction is the market making newer highs as it's going up. But even if you zoom out from a chart of a period like 6 months or so, you'll be able to clearly see where the market is actually going to over the long term. And a mistake people usually make, and I made when I was starting out, is looking at very short periods and saying, like, for example, here, like just because the market is going down over, these are like, I think, four days or so, the market is bearish. Now I'm looking to sell. No. The key thing is to be able to look over a period of like 6 months to a year, what has been the trend of that market. Then you only look for trading opportunities in that direction. So if it's going up, I'm only looking for bullish signals like this. This is a bullish pin bar, a bullish tail bar, bullish pin bar. So I'm only looking for anything that is bullish, that is indicating that the market is going up. So like when the market is going up and then you start seeing, let's say like this is just somewhere up here, this is a bearish pin bar. I don't actually trade it because there's a likelihood sometimes it will work, but sometimes it will fail. Like this didn't go lower enough. You can see here there are bearish tail bars, pin bars, and you can see how they failed because they were against the trend. So using this simple way of analyzing a chart, you can be able to see what the trend is and then only trade in the direction of the trend. So if the market was going down, you only look for bearish candles. So you've been able to learn how to identify entry signals. But then the other thing that you can use these candlesticks for is, for example, you can be able to use them to identify what is called a stop loss. So what a stop loss is ideally at what point if the market goes against you, should you actually let the market close you out automatically so that you don't lose any more money. So a candlestick can be able to help you to identify a good place to place your stop loss price. So like, for example, this is a pin bar. You might be able, whenever you get a pin bar, you can either enter at the halfway point of the pin bar or you can be able to enter at the break of the pin bar. So personally, I usually use entering it at the halfway point. So if, for example, the market gets to the halfway point, where exactly should your stop loss be? So your stop loss should be at least below the low of the tail, like down here. So it can either be below below this particular tail. So this is a good point to be able to place your stop loss, so that at least you can make sure that the market does not easily stop you out. So this is just one simple way in which you can be able to identify a stop loss area to be able to limit your risk to avoid you blowing up your account, which is a common thing that happens when you're starting in trading. So if, for example, it was the other way around, it was a bearish signal, then if, for example, it was this signal, then you'll be able to place your stop loss just above this particular price point. So a very simple strategy that you can be able to learn and practice in terms of how to be able to implement it. So candlestick chart analysis is just one of the first parts towards creating a profitable trading strategy and finding success in trading.